Pandora will release fourth quarter results this week, and to prepare, we're going to take a look at where consensus estimates stand relative to management's guidance. For the guidance, we'll be using the details that they provided on the third quarter conference call. And we also got a couple of interesting news points this week from Pandora. We got the issuance of convertible notes, and we got the ruling on royalty rates for 2016. So we're going to take a look at those details as well. If you'd like to download this model and follow along, it's available on our model blog page from our homepage, gutenbergresearch.com. You just click this tab, find the Pandora blog, and then scroll to the bottom. You'll see we just inserted our model here and also a document which describes our approach as well. So before we get into the guidance, let's take a look at those two important disclosures that management made this quarter. So first, let's look at the convertible notes. So overall, $300 million of convertible notes. They're expecting to have approximately $297 million in proceeds. From that, they'll be spending $37.5 million on hedging capped calls, and the initial conversion price per share is $16.42. So those are the key items that we kind of introduced into our model. So let's take a look at where we put those. So we're looking at the December quarter. You scroll down to the cash flow statement, and you can see that we put the proceeds here, and that's net of those capped calls. And that will end up in our balance sheet. And then that's also going to change our weighted average cost of capital in our discounted cash flow valuation section. So they also gave us that the average cost is going to be about 175 or 1.75 percentage points per year. And for the effective tax rate, since the company is basically hovering around the break-even point, we just left that at 0. So we're not actually giving them any benefit for tax savings on that debt. But overall, it did reduce their weighted average cost of capital. And since the conversion price is $16.42 a share and shares are trading below $9, they're not dilutive at the time, but we'll also get some new details on the dilutive impact for future periods in management's share count disclosure this quarter. Now let's take a look at the other important development this quarter, and that is the Copyright Board's conclusion on royalty rates for 2016. So if you've been following our Pandora earnings model, you'll notice that our 2016 gross profit is actually a bit lower than what we used to have, and that's to reflect the fact that the royalty rates are now 15% higher than what the company had paid in 2015. And there's a great disclosure on their investor relations page which describes the changes in the final ruling from the Copyright Royalty Board. So definitely take a look at that ahead of this release. So now that we've gone through the important developments over the quarter, let's do our typical preview analysis where we look at management's guidance and compare it to consensus estimates. So for that, we're going to use the disclosure that they gave us last quarter. And you'll see that they start with the fourth quarter guidance. So on the revenue line, they expect revenue to be between $325 and $330 million. And if you look to our consensus-based model, you can see that the street is slightly ahead of that guidance at $335 million. Next, management gives us guidance on the adjusted Ebitda. But before we get into that, let's just take a look at our operating expenses as a percentage of revenue. And we're going to compare that to the results from the fourth quarter. So if you scroll down below our income statement to our segment details, you can see a section on ratios, and you can see that we do product development costs, sales and marketing costs, and G&A as a percentage of revenue. And we've actually brought it down just a bit, each one of those items, in the fourth quarter this year, and you'll notice that that's a similar trend that we saw in the fourth quarter of last year, where it decreased slightly from the third quarter. So this is really just to reflect the typical fourth quarter seasonality. Now, with the adjusted Ebitda, there's also some non-GAAP items that go into that. So let's take a look at management's guidance for those items and come back to the Ebitda. So they expect, stock-based compensation of approximately $32 million and amortization of $6 million. And again, in our segment section below the income statement is where we keep our non-GAAP adjustments. And you can see that we set the depreciation and amortization to $6 million and stock-based comp to $32 million. So they also gave us some guidance last quarter on the pre-1972 recording settlement. So they took a charge of about $58 million in the third quarter, and they said that the fourth quarter would be about $7.3 million, with the remainder spread out over 2016. So we're just meeting management's estimates there, and you can see that with these purple cells. Purple cells represent the company guidance. So overall, that gets us to an adjusted Ebitda of just over $30 million, and that's the top end of management's guidance in their press release. So they guided to 25 to 30 million, and that really just reflects the fact that this model is now meeting the consensus revenue estimate, which is about 5 million higher. So once we get down to the adjusted Ebitda line, that actually creates about $300,000 in difference from management's guidance. So not a big deal there. So finally, management gives us some guidance for the diluted share count, which they estimate to be 224 million shares in the fourth quarter. And it's important to note here that they have not included the ticket fly results, so I guess we're not expecting the transaction to close in the fourth quarter. But in the year 2016, you see we've actually increased our share count, and that's to reflect the additional shares that we're going to see come on board when the ticket fly transaction actually closes. So after inputting all of management's guidance into our earnings model, we were in fact able to get back to the consensus EPS estimate of 7 cents per share based on that guidance. And keep in mind that there's maybe a penny or so of play in the EPS number because the total revenue is about $5 million ahead of management's guidance. Also keep in mind that they're operating at a loss, so if this revenue base increases, and the ratios stay the same, the loss will actually get a little bit wider. But overall, we can say that the street is basically in line with management's guidance heading into this release. So now let's talk a little bit about our valuation heading into this release. So scroll down to the valuation section below the cash flow statement. And you can see that we've changed our multiple. So we used to use a next 12-month price earnings ratio, but since the company is operating pretty much near the break-even point, it doesn't really make a whole lot of sense. So we actually pushed that out, and we're now using a price earnings ratio based on the consensus 2017 EPS estimate. So our current multiple is 19 times, and after the company releases results, we're going to keep this 19 constant and just plug in the new December results and any new guidance they give us for 2016, and that's going to give us a good indication of what the valuation change should be. And on the discounted valuation summary, you'll also note that the weighted average cost of capital did come down a bit as a result of those convertible notes that they issued this quarter. But keep in mind that they are dilutive when shares get to around the 1650 mark, so if they ever do get back up there. So that's something to keep an eye on. Be sure to check our blog after the call. We're going to post an updated model, and rather than do a video, we'll just post it to our blog, and you'll also be able to download the new results at that point. And if you're interested in financial modeling, subscribe to our YouTube channel.